Hello traders, welcome out to the Options Report. This is Coach TC, Tyler Craig. Today we're talking about interest rates and bond prices. Interest rates have not been that interesting to talk about for years now, but they're finally going up, and so you're seeing more articles and more discussion on the impact of those higher interest rates on the stock market and other things. So that was the focus of today's write-up in the Options Report. Talked a little bit about bond yields and bond prices. So I just wanted to share a quick illustration of the relationship between bond yields, which is essentially interest rates, and bond prices. So the relationship is inverse. When interest rates go up, bond prices tend to come down. They're on opposite sides of a teeter-totter. And here's a good way of understanding why. Let's say back in 2016, when the yield on the 10-year bond was 1.5%, you bought it. So you bought a bond giving you 1.5%. What that means is if you bought $10,000 worth of bonds, you'd be getting paid about $150 a year in interest. Okay? Interest rates have gone up since then. So new bonds that are being issued by the U.S. Treasury are yielding right now, let's say 3%. So suppose that you want to sell your bond. You want to be done with it. So you come to me and you say, Tyler, I have this fancy pants bond yielding 1.5%, $150 a year. Do you want to buy it from me? And I say, well, I don't know. I mean, I like you. Sure, I might buy that bond. But you know what, Frank? New bonds are paying me 3% a year. Your bond's only paying 1.5%. So your bond is not near as attractive as these new bonds that are hot off the press.